just for the starters, I'll just give a brief on why we're doing this. It's because the winter market has frozen funding for a lot of startups and it's becoming difficult to raise money. But having said that, the early stage startups aren't facing that much of a challenge because their business model is good enough for them to raise money initially. But this problem comes in late and growth stage companies. So today I just want to know from you as to how is it that startups should look for raising money since you yourself being a founder and now are running a fund. So before we get into that, I just request you to give a short introduction of yourself before we begin.
Great. Thank you for having me here. I'm delighted to be here on Radically Yours, and hope we have a useful session for all your listeners and viewers. Very briefly, I'm a former founder. Started my first company during the first dot-com cycle. I was in my 20s, and so I built something like a mobile commerce application for very early phones, very, very early. So right in the beginning of the mobile internet. And raised a lot of money, raised $20 million, was very young, didn't understand. So was also burning a lot of money. Had a lot of traction, but at the end of the day, we got dot bombed. What dot bombing actually is, 2001 played out pretty much the way 2022 is played out so far. It's almost repeating itself. That's the interesting part. So the mood in January was very different from by the time the mood in July happened. In fact, I remember I had to close my company in July. So I still remember. And in Jan of 2001, I had buyout offers for my company, right? So it turns very quickly. Anyways, I sold the company at a loss to Motorola at that point in time, moved to Silicon Valley. And I moved about a couple of years later from New York to San Francisco. So I created my company in New York. By that time, there was a 99% wipeout of all the internet companies, all the startups. And I'll try and talk to you a little bit about how to compare these two scenarios. I don't think there will be a 99% wipeout, first of all. So I think there's no need to panic for anybody. The environment was very different. It was very early. Those business models didn't even exist. There was hardly any revenue. Today, we have very good companies, good margins, all of that. I joined another company. It was a photo sharing site called Snapfish. And I was the head of mobile, creating mobile apps in the pre-iOS, pre-Android environment. And that company was very successful, got acquired by HP, Hewlett Packard, for $300 million in cash. So that was just a very successful outcome for me personally as well. And so I would say with that, I closed a chapter building and exiting mobile internet companies for 6 years. After that, I returned to India and I wanted to invest in the very early stage space, but it was too early. I think I remember at that point in time, somebody said we had 3 million internet users in India, right? Which was nothing. So I said, I will invest personally. And I was running a late stage fund, which was a hedge fund called 8 Capital. And we were seeded by JP Morgan. And so my day job was just, investing in old economy companies, helping to turn them around. My weekend job was meeting founders and, figuring out where is the opportunity. When I moved back to India, I moved back to Mumbai. I had been out for about 10 years. So I went to NYU and then I worked in Wall Street and, all of that. So I felt a high degree of friction in my life. That was almost inescapable around me. And rather than complain and say, oh, this country sucks or whatever, do the typical NRI thing, I tried to take a more constructive view. I said, okay, we have everything that is there, in these developed countries. We have the roads, we have the infrastructure, all of that. Why is there so much friction here? And where I came to was I said, India has a user design problem, right? So very early on, I came to this conclusion, which has still been sort of like a guiding insight for me, is that India has a UX problem. So obviously it's very hard to change the UX of our cities because, we don't run these cities, the municipal corporations run them, and there's a lot of historical infrastructure. So I started to think, I said, what if we were to digitize our lives, right? What if my consumer life was online? What if my small business, operations were online? Can I change things to remove friction? And the more and more I thought about it, it was a no-brainer. And I started to invest in companies which were removing friction from the lives of small businesses and consumers by digitizing certain journeys, consumer journeys, small business journeys, and I'll delve into that a little bit. And actually started to work really nicely. So my first check was in a company called carwale.com. I'm sure many of you who are interested in buying cars, start your car buying journey there. It was a no-brainer because you could go up and down, from Nariman Point to Worli and wherever you want to go, looking at car dealers, or you go online and you pick the car you want, and then you go to the dealer and you buy. So that was a very successful investment. I got lucky. So I think it's very important to get lucky in life. If you make a few good investments, you gain the confidence. Few other investments I made, which were in the non-tech space. A couple of them went public, which was pretty amazing for me. So I would say, I had beginner's luck, a lucky streak. And the good thing I did is I didn't take that money and all those profits and go buy a fancy car or do anything like that. I rolled it back into new investments, and that's what I have been doing. So I'm one of the earliest angels in India. So about 15 years now, backing companies. And I gravitated more and more towards fintech because it hit me that money lives on servers, but the banks are always shoving paper, right? So as a result, I realized there is a lot of opportunity to digitize money. And I had a moment of epiphany, to be honest. I was at a bank branch trying to open a bank account for my company. It took them a month. They hadn't been able to open an account. So I was like, what is going on? Like, why can't you complete this KYC? And they had no excuse. They had no reasons, just bad process, right? So I came out of that bank branch and I ordered an Ola. Ola had just come up, right? So in 3 minutes, the Ola delivered, showed up. And now I'm on my way from Nariman Point to Worli, and I'm thinking to myself, how on earth does Ola deliver a 2-ton mass of atoms in 3 minutes? And these banks are not able to move data in a month, in 30 days. Something is broken, right? So I said, okay, let's take a constructive first principle approach. Let's find out what is broken. Instead of saying banks suck, let's get to the bottom of it. So I began to meet various CTOs of banks and CFOs of banks and started to ask, what's going on? So first they all blamed RBI. Oh, RBI policies are like this, that. I said, RBI doesn't tell you to move files slowly. RBI just says these are the things you need to do in terms of KYC or whatever. And I realized all of these guys were running on really old legacy software. And I said, okay, maybe we can change the software. Maybe we can change parts of it. So that kind of instructed many of my investments in fintech. And I'm happy to say that it's been a very successful journey so far. This thesis of removing friction worked out really nicely. I would say from 2012 to before COVID began, my thesis is very simple in fintech: 5-minute bank. I said there should be a bank where everything happens in 5 minutes. Because if you notice, after 5 minutes, we kind of all go a little bit crazy, right? We're like, why is it taking so long? I'm sure, even your grandfather at some time when he came home, he said, I want some tea or something. And somebody said, 5 minutes mein laate hain, right? After 5 minutes, kya ho raha hai?
Yeah, right. अब 2 minute हो गया है 5 minute का.
Right?
People are relying on that 2-minute Maggie theory for everything.
Yeah. So I think, across the world, I've been to so many countries. I've realized that 5 minutes is this barrier after which people just lose patience. So I think if you can handle everything within that, like onboard a new customer, deliver a card, deliver a loan, open a deposit account, or whatever, right? I think ultimately India will become a 5-minute economy. When we have drones and all of those things, that will happen in the future. That's where the world is headed. We are moving to an instant economy, but we are far away from there. So we start with money, then we start with other things. So broadly, that's how I have been investing. So some of the companies you may know that we have seeded. Slice is one of our companies, which I don't know if you have a card, but some of your viewers may have a card. I'm a very early investor in that company. Done really well. And if you see even the Slice ads that come out, right? It's about how fast it is, right? That's because when I invested, one of the things in our discussion that I always spoke to Rajan about, who's the founder and a dear friend of mine. I said, you have to onboard under 3 minutes. You got to do that, right? So he kind of like just nailed it at that level. Um, and then we also seeded the company, which was the infrastructure provider to Slice, which is M2P, which has also done very well. So that company was last valued at 600 million. We went in at seed stage 2 years ago. So that's a very good investment. Slice, obviously. Pardon me?
You spot them at such an early stage that you got a chance to invest into it at seed stage only. How did that happen?
I think most often what happens is people disconnect, right? Some founder I know will say, take a look at this company, and if it makes sense, I'll just write a check. I'm not thinking too much about who else is investing and all that. In fact, I would say there's one common quality across all our founders. They tend to be underdog geniuses, if you ask me, right? They're not the guys who have gone to the big VCs and raised money or whatever. They're guys who are solving fundamental problems, and they're so deep in it. They actually think that everybody else should understand their point of view. And I think what I have done well is try to be a good listener, right? Really trying to understand what they're doing and why this thing should exist. So, anyways, it's worked out very nicely so far. So we've had a number of companies. So we formalized into a first fund in 2019. We closed that fund. We've launched a second fund, which will be closing very shortly. First fund will deliver, I think, 3 unicorns. The first one came out, Slice. M2P will be the second one. Third is a payment gateway company called LeaseBus, growing very strongly. So all these companies are in the 100 million revenue class, right? So with that, I think what I'm going to do is take a pause and talk to you a little bit about how to think if you're an early stage founder. So we've seen these journeys. So none of our founders have had it easy at seed stage, to be honest, to raise money. So if they were raising in today's environment, they'd just be fine. It won't matter, right? They're used to this kind of a problem. So these are companies which have gone from, sub 10 million valuation, some are at $1 billion, some are at hundreds of millions, and so on. At this moment of time, I think historically, if you see, this is probably the worst summer to raise money. I got to be candid about it. This is a tough time, right? My advice, pardon me?
What do you think is it tough?
See, I think what has happened is you have to see how VCs make money. Two things have to happen, right? One is revenue must multiply. So at seed, very often there is no revenue or there is very little revenue. So the velocity of revenue growth that kicks in obviously generates value, right? The second thing is because these companies are not profitable, very often they will get valued on a revenue multiple.
Yeah.
Right. So if the revenue multiple is growing and the revenue is also growing, so you have this twin multiplier effect, which is creating, right? Yeah. Which is getting created. So that's why, like, for example, for me, M2P was a 60x, 60 in 2 years, right? So Slice is like 150x. So Slice over 5 years, 150x, M2P over 2 years or so, 60x. And then, we have one more company which is coming about to raise, that might be at 20x in 18 months. So also it was the point at which we entered these companies. On the other side, if these valuation multiples compress, right, obviously there is a challenge. So then obviously so if I enter into a company, let's say 10 times revenue, and the company grows 10 times. So actually my valuation jump will be 10x. Just saying, I'm not calculating dilution. But if the company's valuation goes to 20x multiple revenue, right, then I'll make 20x. On the other side, if the valuation multiple compresses to 5x, so even though the company grew 10 times, I'm only going to make 5 times. So what has happened is in the public markets, all valuations have gone down a lot. So whether it was in SaaS or payments or whatever, it used to be 20 plus. It's all now down to single digits, 5x, 6x, 7x. So what has happened is all of these pre-IPO companies which were waiting to IPO, they were all being valued at 20, 30x, growing fast.
Yeah.
So they thought, chalo, we'll IPO. We'll at least get the
Mhm.
same multiple. And then suddenly those valuations have gone to 1/3.
Right.
So their valuation is getting now compressed, or they have to grow it. Now what happens before the pre-IPO guys, let's say IPO is happening at Series E, the Series D guy is saying, oops, maybe my valuation is a little bit higher than I thought. So there is a
Yeah.
cascading effect. So that cascading effect is going to come to early stage. In my opinion, it hasn't come yet.
Mhm.
So early stage deals are occurring, but people are being very careful.
Yeah. But you see it coming soon to the early stage.
By the end of the summer, I mean, it will just recalibrate. So what is happening is, I think, valuation is a pendulum. Okay. So valuation is a pendulum that swings between investors and founders. In times of capital scarcity, the pendulum is with the investors. So we will tell you what valuation, right? So the investors can become price givers, founders become price takers.
Mhm.
When money becomes cheap, like it was in 2021, the most successful founders will become the price givers to the investors and they become price takers. So there is a swing happening right now.
Mhm.
There's a calibration that is going on. So a lot of investors are saying we need to see how far this pendulum swings.
Mhm.
Because last few years, the pendulum just kept swinging away from them. The diligence
Yeah.
period was reducing. They were getting rushed. It was very competitive. They were paying a lot. So everything was on future promise.
Mhm.
Now suddenly they're saying, okay, show me. So, but I would say that, look, there is a lot of dry powder. That's the good news.
Right.
There's a lot of money that has been raised. So for the right founders, the right teams, the right ideas, there's going to be a lot of money.
Mhm. What do you think has triggered this, the pendulum swing that you called as? I mean, is it just the IPO performance of some of the startups or something else also which triggered?
I think it's largely got triggered because of rising inflation. And the Fed has been raising rates now finally. So when interest rates are going up, risk aversion also goes up. So in general, you will see historically stock prices and interest rates always go inversely. So if interest rates are going up, stock prices start to go down, at least the multiples start to go down. So that is what has been happening. And I think this whole Russia affair that happened, Russia-Ukraine, it was not anticipated. We know that supply chains were broken last year and the year before because of COVID, right? And so a lot of these supply chains coming out of China and wherever else. So those issues were there. So some inflation was there, but people kept thinking it's transitory.
Yeah.
But when Russia happened, suddenly like, oops, we don't know what's going to happen, right? So oil is going up, everything is going up. But I think we are kind of at peak inflation right now. That's my sense. So I think this is probably a tough time that way. So let's come to the point here. I mean, what is a fundraising environment, and what should you do? So let's try to just focus on, should we just say seed stage founders?
Yes, we can.
Would you think, I mean, where do you think your audience would be like? Would they be very early founders? Would they be Series A guys or girls? What do you
Yeah,
think?
but they would love to know the path ahead for themselves also. So we can maybe talk about both stages.
So let's say, okay, there is pre-seed, there is seed, there is Series A and so on, right? So historically, pre-seed is idea stage. Seed is you made something. There's early product market fit. Maybe there is some revenue, maybe not, but definitely there is some uptake happening from your customers. Series A is generally you are clocking about $1 million annualized run rate. And I'm talking about net revenue, which means that if you're a SaaS business, that's net revenue.
Yeah.
So that means you should be in the range of $70,000, $80,000 a month. You could even be 50. We're growing very fast. So you will get, a Series A valuation, and then Series B, obviously, maybe 3 to 5 million, and then so on, and just, how it goes on. At this moment of time, I would tell you most VCs, unless you are exceptional. Exceptional means you've come from a great pedigree, like, you've gone and worked at like a, let's say you're doing a fintech and you're part of the fintech team of a Flipkart or a Paytm or a Razorpay or whatever, right? And you're stepping out. it's very unlikely they're going to write you a significant or a decent check at your pre-seed at idea stage. So it's kind of going to mean revert back to where it used to be in the 2018 era, right? So my advice to founders who are raising money right now is, if you have an idea, try and raise from angels, first of all. Second of all, get to the early product launch point at least. Otherwise, you're just going to keep waiting, talking to VCs, and many of them will say, yeah, you are a little bit early for us. We'll keep in touch. All of that stuff, right? You're always better off approaching the VC when you got some traction and creating that excitement, first of all. Now, you may say, I'm a business person. I don't know how to code. I need money to go and get a developer. Then you are in the wrong space. You definitely need a technology, I would say a CTO co-founder. When I'm looking at an ideal team today, I'm saying, okay, early team should be able to build the product. The business people actually come later. Once the product is built, then the business people come to sell at the end of the day. Right. And so I would say raise angel money and get going. At the same time, I would say there is no land grab situation right now. The interesting thing that happens whenever these kind of market resets occur is that this land grab mentality that is there, oh, I'm too late, this, that, it's all useless. Because many of these companies just been bribing their customers. So that's not sustainable.
Yeah.
Right? So there is no pressure at this moment of time.
Yeah.
If you like an idea, you're doing something right. Yeah. Pardon me?
You said raise angel money at this point in time, but then reaching out to such investors is also very difficult. So how do you suggest should these founders go to, and which platforms would you recommend them to find these angels?
See, there is Angel List, there is Let's Venture. These two are there. What you got to do is you got to find a believer who is a lead syndicate out there. And, they will at least, help you raise a few crores. You can get that done easily, in my opinion. Try and do a convertible. That'll give you some flexibility. So what will happen, everybody will keep looking at each other. It said, okay, who's going to invest first? Then I'll do it. So if you do a price round, which means that everybody comes into a shareholder agreement, filling that agreement is very hard in terms of the number you have to raise. So you have to reward people for who come in first. So let's say that you're saying, I want to raise $1 million, right? Let's say you're thinking, oh, my best friend raised, 3 million at 15. It was an idea, 15 million pre or post. It was in February. Why should I not get that valuation? The times have changed, right? That's the point, right? Zomato is no longer the same share price it was. It's down to wherever it is today, right? That you can't say, oh, I'm going to IPO today. Zomato got it. Why am I not going to? It's the same situation. So accept the truth and understand the reality and deal with it. That's the point first. I would say, look, you can obviously say, hey, I want to raise $1 million. You can start at, let's say your ideal target was 10 million, post you dilute 10%, right? Now that's what you would want. Maybe you're not going to get it. So the smarter way to do it is say, listen, maybe I'm going to keep it at 5 million and I'm going to raise 500,000 at 5 million. So whoever comes in, it's a cap at 5 million. I got my $500,000. Now I get going. I got some progress. Then the next tranche I open at 7.5. Then I open at 10, and then I close it at $1 million. I'm done. So उसमें क्या हुआ कि you have a staggered dilution. Instead of raising $1 million at 5, where you would have diluted 20%. I'm just saying. Now you'll sit somewhere between 20 and 10 if you want to think of it that way. That's one way to do it. On the other hand, I would say that there will be many investors who will put on their Lalaji hats now. So I'll give you 1 crore, you give me 1/3 of your company. Do not do that, because you will not be fundable after that. Because the investors also want to see enough skin in the game from founders, right? You don't want a situation at Series C, the guy is 5%. It's a problem, right? So my sense generally is that try and keep your dilution somewhere in the 20 handle, below 20, above 20, somewhere in that range. Seed A and so on, then you're fine. That's historically what we've seen across the world. That's a good number.
But do you suggest people raising equity financing or debt financing at this point in time?
If you already have revenues, um, and you have a very clear path of monetization, if you spend so much money, you're going to get these customers, you're going to monetize them. So let's say you're a SaaS company, you know that you're going to make so much money and you're going to pay back that cost, your CAC. Then I think you can go and get some, revenue-based financing or something like that. Or let's say you're a D2C company, you have nice fat margins, you're already clocking 35 lakhs a month or whatever, or 50 lakhs a month. Of course, you should go and get revenue-based financing because it's completely worth it for you. But if you're day zero, unless I would say you are in a Y Combinator or something where you have high visibility of funding, I would not advise it. So I would say if you have surety of when the funding will occur, then you can bridge with debt at the very early stage.
There are a lot of crowdsourcing platforms as well for revenue-based financing these days, where you get money from retail investors too. So do you think those platforms are good enough to raise the initial set of capital, especially when you're starting up?
You're talking about debt or equity? Sorry.
Debt.
I don't know. I mean, I'm not aware of these platforms which will, there is 8VDX, which is dedicated to YC. But beyond that, I would say, and 8VDX does a good job. So 8VDX, for the listeners, is also one of our portfolio companies. Also happens to be my brother's company. So I'm not invested from the fund, but I invested personally. See, when you enter YC, there is a 3-month period where they say, don't market your company because we'll groom you, we'll get you ready, we'll get you ship shape so that you are at your best when you step out for demo day. So you still need money because you're growing. So there, you have very clear path to pay off that debt. But here, if you start off at like such an early stage, I think it's difficult. Yeah. That's my point.
Should the founders raise non-dilutive alternate sources of capital initially, or should they directly start with the angel money, which gives it their equity as well? Which one is better?
Do you think they will get non-dilutive debt at this moment of time when on day zero? What do you think?
Yeah, I think if you have good contacts in the bank, maybe then. Otherwise, it's difficult.
I don't think so. I don't think even small business lending is one of the more poorly addressed sectors by banking, by the way. Even if you have a 5-year history, they don't want to give you any loans. So it's very unlikely that a young startup is going to get a small business loan. Yeah, very difficult. That's my view. So, if you can get it at low cost, take it. Right?
Yeah.
Don't go to a money lender and borrow at 3% or 4% a month. That's not a smart thing to do.
Yeah, right. Also, while negotiating the term sheet, especially at late stage, the dual class shareholding pattern really comes of importance because it really determines how much of an equity will you be holding at the later stage. Like companies like Facebook and Snapchat still have good shareholding from founders, but in India, it almost gets reduced to single-digit number when it comes to Series D or E. So how is it that this dual shareholding pattern can be helpful?
So, if you own 5% of the company and you're the CEO, you're the one driving all the value, I think you are just trying to ensure that you don't get kicked out. That's why you want the dual class. You get golden shares, which may give you vastly more voting right than your actual ownership. So normally if you own, let's say 100 shares in a company, let's say 100 shares were issued, but the founder has only 5 shares. So that means that founder can only have 5% voting power, right? So, but she's going to say, listen, I'm at the helm, I'm the one deciding everything, I want to drive this company for the long term, make those decisions. So she may demand that, I want to have, let's say 51% voting right. And if she's truly special and she's done a great job and people believe in her, they might do that. They might offer it to them. So again, in companies which are truly exceptional, investors are okay to give them that.
Got it. And when do you think is the time ripe for institutional investors to come into a company, and when should a founder approach such kind of players in the market?
When you say institutional investors, you mean venture capitalists or later stage people?
Yes, the VC funds.
So I'll tell you a little secret about how to handle institutional investors, right? I'm one myself. Uh, so I've been on both sides of the table. When you go to raise from institutional investors, talk to all of them at the same time.
Okay.
Don't do serial processing. This is a mistake many founders make because many VCs talk to each other. VCs also have their networks.
Yeah.
So if you go, so what will happen is with every pitch, you'll keep improving.
Yeah.
Because, first pitch you're making, sometimes you're not that confident. Maybe you got that question wrong in your mind. Maybe you're not prepared for a competition question, whatever it is, right? So what's going to happen is you may pitch to the first investor. The first investor may have a poor impression. Before you approach the second investor, they've already said, oh, I talked to this company.
Yeah.
And I don't think that person was so impressive. So get your act together. Surround yourself with, investors who can be almost like coaching you. Try and get some successful founders to invest in your company and get some time from them and do dry runs with them. Practice. I would say the first 2 minutes of your pitch should be like nailed in your head, completely like a script. Like if I woke you up at 3 in the morning, hey, what does your company do? Should come out, right?
Yeah.
So it should be that good in my view, because at the end of the day, you can see two kinds of companies in general. You see some great founders building great products, not so articulate, not that great storytellers, and at the same time, you're like, how on earth does this company raise all this money? I don't even know the business model.
Yeah.
That guy is a great storyteller. So storytelling works. Now, when you combine a great business, which has good margins, good traction, with a great storytelling situation, you have magic. So I would say, prepare yourself. Don't be in a rush to go out. Even if somebody says, hey, let me introduce you to my friend at this big VC. So thank you very much. Get connected. He said, I will approach you in, let's say you are thinking about raising money today. I'm going to approach you in August when I'm ready to raise. In the meantime, try and get all your introductions set up. Then go out and say, I'm talking. What will happen is when an investor is evaluating you very seriously, they will very rarely talk to other people about you. It's a competitive situation.
Yeah, that's right.
So you want them to be in a competitive situation with you.
Yeah.
Otherwise, the first guy goes and says something, oh, I really didn't like this guy or this girl for some reason, blah, blah, blah. They may influence other investors against you. And this happens a lot. I've seen this happen too many times. So it's very important to keep control of the process in your hand. Otherwise, you've lost control.
Yeah, but you said that approach all the investors at the same time. But how does that work then?
Means, over a 2-week period or whatever it is. So even if let's say that, I'm sure you know some VCs. Some founder comes to you and says, okay, I'll introduce you. You tell me when you're ready. So you do the introductions all at the same time. Trust me, if you're in an interesting company, it will hit the VC, gossip network. It'll be there. It'll start to buzz because there are a lot of analysts who keep talking to each other. They all have the same background, all of that stuff, right? So you'll have some buzz. You want the buzz to be around FOMO.
Yeah.
You don't want somebody saying, oh, I didn't like this company. And then everybody else is like, well, I don't know whether I want to do this deal or not.
Yeah.
So that's why you got to be clever about this.
Yeah, because once you prepare and then go, and if you nail your pitch, of course, every VC is going to talk about it, and there's going to be a buzz about it in the market that this deal is very hot and happening, and then maybe you might get an upside on your valuation also because you'll have so many term sheets from different VCs for that matter.
Yeah, I mean, I think, look, if an investor feels that I'm the only person investing, sometimes they may second guess and say, oh, am I really sure? Not this, that, whatever it is.
Yeah.
But if they say, oh, this smart VC is already investing, you want to get as many people committing to you. That will ensure your deal goes through. That will ensure you get the terms that you want. That's what I'm saying. That's how you take the bargaining power back into your hands. That's the point.
So you said that the storytelling is very important. So what are the key elements that a founder should have in their pitch deck and in their pitch for any good level of conviction? Maybe you can speak about fintech since you've been into that space for quite some time.
See, like you have product market fit, I think most of your audience would understand that. There is always going to be a, a founder and a VC fit, right? So for example, I mostly focus on fintech, my partner focuses on consumer. If you're going to try and pitch me at tech, I may not be that keen because that's not an area I focus on. So do your homework. So just like, you're going to establish your target market, then your serviceable market, and you say, okay, what is the persona? Who do I really want to go to? Look at the portfolio of the VC, right? And that'll start to give you a sense, and look at who the winners are in that portfolio. Very often the VCs are biased towards the kind of companies that became winners. Remember, a venture capital firm is defined by its winners. It's not defined by its money or capital or whatever, right? The truth of the matter is every smart VC knows that founders make venture capital firms, not the other way around. Money is a commodity at the end of the day, right? So let's say a great founder came to me and I was not so sure I'll give that person money, and I turned that person down. Somebody else gives that person money. At the end of the day, that money was replaceable. But is that founder replaceable? No. This is my point, right? So if I missed investing in Rajan at Slice, I missed it. That's it. If I miss investing in Madhu of M2P, I missed it. I am replaceable. Madhu is not. Rajan is not. So that's the point. So first thing you should understand, you are the one creating value as a founder, right? Now, what do investors really look for? Look, I think you have to understand this one particular dynamic with technology companies, especially in the internet. The winner of a category at maturity, when the win is decisive, is usually worth more than all the other peers put together. So don't be a number two.
Yeah.
Right? Don't be a number three.
Yeah.
And especially in a period of time like this, investors will find safety in putting more and more money behind the biggest winner because they know this. So why do I say this? Let's look at some examples. Tesla, right? Worth more than all the car companies put together. At $1 trillion, right? That's at peak. Amazon, you know the story there. Look at Airbnb. I've not done the math, but it has no competition, first of all, or very little competition. I'm pretty sure it's probably a good portion of most of the hotels in the US, if you look at the market cap, right? So similarly, what will happen is in each category, whoever is a winner first will be worth more than all its competition, then will be worth more than its the challenger, right? So if you see Flipkart when it started, right, at some point it was worth more than your future retailer, and then I think today it was supposed to go IP at 70 billion. If you remove Reliance Retail for a second, it's worth more than all the entire retail sector. I think somebody has a question. Let's take a question.
We have the questions which we will take after you complete this. We can take it after you finish.
So the point is that the tolerance for backing a number two at this moment of time is much lower. Now, I'm not saying you should not try to disrupt the leader, but the leader should really, really suck for you to have a shot at it. Don't say, okay, I'm a little bit better, and be honest about it. Because most customers are pretty casual about it, right? They are not going to be as excited about your product as you think they would be. So I would say approach a white space where there is a deep pain. Don't worry too much about the market size. Many VCs will tell you your TAM is too small, this, that. I think that's not the right VC for you there. Indian economy is deepening to a point, the digital economy, that even what looks like niche today will become a norm. I mean, we've had a great track record just backing in companies like that. When Rajan said, I'm going to launch a challenger card, everybody was saying, Indian credit card market is so small, same 33 million, 25 million people have cards. Indian people don't want cards. I'm like, what nonsense, right? M2P wanted to do the same thing. All the VCs were saying the same thing. The card industry chalega hi nahi, right? So obviously we know they're wrong. I remember when I showed up in India, everybody's like, e-commerce, India doesn't have a base to create e-commerce. It's too small. Who will buy online? This, that, whatever it is. There are a lot of large markets. You just have to know how to unlock it.
Yeah. So we will get to the question which Raghav has. He's saying that why raising at such early stages is still a challenge, and what are the points that we can look at while someone is raising funds for their startup, which is in an early stage.
I'm sorry, I was reading this. Could you just repeat?
Yeah, so it says that why raising funds at early stage is very difficult, and how somebody can, get to fund houses to convince them to put money into their funds in their startup at an early stage. So that's the question Raghav is asking.
So first of all, I'm pretty sure that most of you know which are the VC firms, right? I don't think that's that hard. You can just Google and you'll figure it out. If you're going to write an email, so I get a lot of messages on LinkedIn. It says, sir, I have a really cool idea I want to discuss with you. I'd love to discuss that, but there are 1,000 people like that, right? So am I going to spend 1,000 hours talking to people about their cool ideas, or I'm going to talk to somebody who says, hey, I launched this, I'm having this great early traction. This is what my growth is month on month. This is the problem I'm solving. And therefore, can I have a chat with you, right? Now, again, many people don't respond to LinkedIn. Reaching people is not that hard.
Yeah.
What I mean with that is that how many different ways do you need to think through before you arrive at somebody's email address, right? It's going to be either Bill at Microsoft, Bill.Gates at Microsoft, right? Bill G, B Gates. I would say blind CC all of them. That's what I used to do when I was a founder.
Yeah.
Right? If I knew somebody's at, John Smith at, bigvc.com,
Yeah.
I would say John at J Smith at John.Smith at, John S at Smith at, sabko blind CC kar do, right? And you'll get there. So when I see that, I'm like, okay, this is good.
Yeah.
There is some hustle factor here.
Yeah.
And please do not use an investment banker to go for a seed round.
Yeah.
Right? Because I am looking at my role almost as an Olympic coach. So when I'm looking at a founder, I'm saying, can she be the person who will completely dominate her category? So similarly, an Olympic coach, like, don't come to me with crutches as a baby, right? Show me something. So that's what I'm saying. This is very basic common sense. Just thinking how to get through. I'll tell you, if somebody writes an email to me, right, I will respond if you made the effort. You send some banker to me, I will never respond. You already sent me the negative signal.
Yeah.
You have to be able to do, and why I'm saying this, if you can't do this much business development to figure out when there is so much news coverage, how are you going to get your customers? Customers are much harder because, here I am, my job is to give you money. A customer's job is not to buy a product, right?
Yes.
So let's see some hustle. That is very important.
Yeah, that's actually a wake up signal for a lot of us, because we tend to send only cold emails thinking that we'll get a response from at least one person, but we end up getting no response. But I think this combination and permutation that you told about emails, it's very interesting, and I'm sure.
Not just that. I think, look at the portfolio of the company, of the VC you want to talk to, right? Reach a portfolio founder there. Maybe you go into LinkedIn, maybe you have a connect. So you got to do a little bit of homework. And I'll tell you, invariably, every single VC, if they get a reference from one of their founders, they will take that call.
Yeah, that's true.
Almost always. And most of us have large portfolios.
Yeah.
So it's a little bit of groundwork if you're brand new. Of course, if you have friends who are already running these businesses or are in the startup world, they can connect you.
Yeah, correct. We also have another question where it's actually a startup founder. He says that they're running the business for 22 months now. They run online store, which is doing an average of about 3 to 4 lakhs a month. And they haven't done any marketing till date, but it's purely on an organic word of mouth that they're sustaining. And they're looking for a fundraise of about $1 million. So he's saying that, is this number too early to quote to the investors, or should he be doing it at a lesser value?
No, so I would basically say, coming back to my point of getting the category winner, right? So the first thought that's coming to my mind is great traction, wonderful. but isn't there already, a dominant player called Licious, or, there's like, I think Meet to Home or something. There are already 2, 3 players who've emerged, right? So what are you going to go do different? That is going to be the issue, because these people already raised so much money. They already built big brands. They're already on Swiggy, Zomato, whatever it is, right? So if you're going into this segment, are you going into a subcategory? Entirely possible. You say, hey, I'm just saying, I'm doing organic or something like that. So you have to very clearly articulate why you're doing something different, why that's a new category, right? So then you can actually, even with this, even if you're doing 3 to 4 lakhs, then the other thing people will look at is what's your growth rate, right? So I would say if you have a 20-30% growth rate month on month for the last few months, that will help a lot, right? Or if you have a good plan, okay, I raise this money, I'm going to grow 10x in the next 12 months because I raised this money. All of those things will matter.
So moving a step forward, let's say you have soft commitments from investors at an early stage. So what kind of instruments should you look at while raising money from them? Should it be safe notes, CCPS, CCDs? What should it be?
Look, I think given the environment we are in, you should try to do safe notes, especially if you're raising money from a bunch of angels. So, when money is available, grab it. Very simple, right?
Yeah.
Otherwise, what's going to happen? The angels are going to say, oh, you find me that lead who will come in, who will price it, this, that, so you'll kind of be stuck in that loop, while the VCs are also kind of like sitting tight this summer. But, your life has to move on. You have a plan. You want to execute. So get that money in and do a cap note, basically a safe note that allows you to take some money, keep making progress, and you keep ratcheting up. This is what YC does so well, Y Combinator, right? You start your raise, maybe sometimes, 10 million, 12 million. At peak, obviously, people were going much higher. And as you keep making progress, the more and more demand, you keep raising your cap, right? So that's one. Now, many investors will say, no, I don't want to do a cap. I don't want to do a safe note. I want to do a price round, right? There's nothing that stops you, first of all, from doing a safe note while you're discussing a price round. The other feature about a safe note also is that an individual investor can sign a safe note. Not everybody has to be on that safe note. So that is very helpful for you. The only risk I would say, which many people don't know about, is that let's say you start your company and your first note is at 10 cap, your next is at 12, then it's at 15. The guy who came in at 10 does not get diluted by the guy who come at 12 or 15. The founder keeps taking that dilution. So it tends to be a little bit expensive. But if you need the money, you keep taking it, build your momentum, keep going.
Yeah, I think that sounds fair. And how much runway should a startup have, before approaching the investors ideally? If it's making revenues or maybe has some traction to count for the number of footfall it can show to the investors.
Look, if you have the ability, let's say you are at seed, you have some early product, like let's talk about Sanyog mystery, right? So Sanyog, if you are listening and you're here, you're raising, you got to raise for at least 2 years, given the environment. So many of us have forgotten that generally it takes 18 months between seed to A and another 18 months from A to B, right? So you need at least 2 years of money, because when you're raising, you don't want to be like having no money, then you have no negotiating power. So you want to make sure that your burn, everything is calculated in that manner. And the other thing you got to keep in mind is that as you approach your next round, you want to have some dry powder for growth. So your VC will say, oh, show me, last 6 months growth. So you want to have money to fuel that growth. So I would say whatever budget you make, keep a delta or a buffer of 30% on top. That's a good rule of thumb.
Got it. You know what problems that I've personally faced with a lot of founders at an early stage is that they get, buried under the pressure from angels that, give us more equity, otherwise we won't invest. And in a bid to raise money, they actually tend to come under the pressure. So, I mean, what should be the ideal size of equity that they should be diluting to these set of angel investors?
Look, I think 10 to 12%, max 15. That's my sense. But make sure you have enough money to that when you do your proper seed, you have traction going in, right? So you're an exciting company. You can actually go and raise, 1 to 3 million at least. So look, what happened in the last 3 years, I can tell you, was an aberration. I have been building and investing since 1999. Invariably, what happens is your seed and A and all of that is highly diluted historically. As your company gains more traction, the value keeps increasing. That's when your dilution reduces, ultimately. This is just what happened in the past. Like, okay, you could just dilute 10% at seed or whatever it is. That was more of an aberration. I'll be very honest with you. So as the world mean reverts back to where it used to be, that's where it's going to settle. That's
Got it. I'm sure you must have seen a lot of cycles. First the dot-com bust, then the 2008 crisis, now the pandemic, and now this winter market. So what is your analysis of these 4 different markets and the startups emerging from these periods?
So I would say this is going to be a fairly shallow recession.
Okay.
Yeah. So I think there is a lot of fear in the market, which I think is a bit overblown, and it's manifesting in public market prices. The reason I say that is I think this recession is going to be closer to 2001, what we had, than 2007. The reason I say that is because, whenever there is a deep recession or a deep market crash, it's usually because of some massive leverage somewhere.
Yeah.
Right, some balance sheets blowing up. The lender has a gun on your head, so you're forced to sell either your homes or business loans or whatever it is. Right, so there is no debt buildup right now. What is happening is basically all the unviable models are getting repriced or swept away.
Yeah.
So when I look back at the 2001 2003 crash, what happened then is very similar to what happened in crypto, by the way. So if I want to run a parallel, the dot-com bust is closer to the crypto bust, because many crypto companies don't have a business model. So suddenly you own these things, your coins or whatever, and you're like, what's the value? I don't know the value. So there's no business model. So similarly, these dot-coms had no business models. They were all priced on highly speculative things, and many of them had gone public. Hardly any revenues and worth like 5 billion, 10 billion, whatever, right? And then suddenly people are like, oh my God, I don't know how to value this thing, or there is no revenue even, right? So in comparison today, I would say many companies have a lot of revenues. If you look at it globally, they are real businesses. Of course, you hear of a Klarna, which was valued at, whatever, 30 plus billion, now down to 6 billion, right? But that company has $1 billion plus in revenues. Its problem is the burn rate, right? So it's very unfortunate it is raising at this time because they didn't manage the burn. Once they fix the burn and if they fix their books well, they'll be back. So I think that so there is a sound business model to many of these SaaS or various kind of fintech or e-com companies that are there right now. So I don't expect that kind of decimation, not 99% for sure. I will tell you that, right? So I would say think about your gross margins, think about your unit economics. Those questions are going to be more early now than they used to be. Earlier on, people didn't care. They're like, we'll figure it out. So expect, be prepared for those questions. The other thing is, as I remember from the dot-com bust, what survived was the plumbing of the internet. Right? That was a really interesting. So many of the destination sites just passed away. Amazon, of course, survived. We know that story. Companies with network effects like eBay, right? That one survived. Talking about land grab, this is the really interesting part. When the dot-com bust began, Amazon was predominantly the leader in books and music. And each category, vertical category, had a leader already, right? And they were massively unprofitable.
Yeah.
So for toys, there was etoys.com. For pets, there was pets.com. There was even for luggage, ebags.com, and so on. All of those buggers died. And they completely vacated the space. And then Amazon said, thank you very much, and kept lapping up each of these categories, right? So I would say that the cockroaches who have been around for a long time, you may suddenly find some value there. Keep that in mind, right? So I would say the most important quality a founder needs to have in this environment is to have a cockroach mentality. Yeah, I am not going to shut my company, no matter what
Correct.
happens.
Yeah.
Right? And I think that even if you're not growing in this environment, it's fine. If you're not raising, don't kill yourself, just survive. You will be surprised that as the last man standing game starts to play out, how amazing your opportunity set becomes. And you will see some very large players just collapse under the weight of their, poor business models and all of that stuff. Wo hoega, right? And so it's very interesting. That's why I'm saying don't be in a land grab mode anymore.
Yeah.
If you're not raising, if you're raising, then you got to be really smart about it.
Yeah,
So
I really
broadly,
love
that's
this.
what I would say. Yeah.
I mean, it's again drawing back to the survival of fittest, and clearly only cockroaches are surviving right now. So yeah, I love that analogy. But I wanted to ask you more about Paytm's IPO performance and fintech, but we are running short on time. So we'll have another session on fintech where we will dig deeper into more elements of fintech in your experience, of course, in it. But as a last piece of advice, what is it that you would suggest founders to do at this point in time?
This is arguably the best time to think about building something, if you are serious about it. Because 90% of the founders who were launching in the last few years were like, it's so easy to raise money. I had an argument with my boss, I'm going to give it a shot. So all the tourists are going to go away. So obviously it's going to be harder to raise money, but if you have a genuine insight into a problem, this is the time. Look at what's happening around you. The great financial crash, gave us the sharing economy, because suddenly people realized I could sell the backseat in my car or the extra room and make some extra income, right? Now we're living in an inflationary environment and we are going to lose some jobs, right? All of these things are happening. So you are going to see new needs emerging, and therefore you are going to see some new trends also coming. Those new trends are not yet evident to us, but I think I'm very eagerly awaiting to see what founders come up with. So many of us, I'm raising my second fund. I have a lot of interest. I have a lot of dry powder. I'm very excited. So if you have great ideas, you have genuine insights, you want to create new categories, please reach out.
Yeah, and reach out with something unique, as you said. Otherwise, you anyways get thousands of emails of people reaching out to you. So I'm sure the audience knows the trick now. Hearing from you firsthand,
For
But
sure,
thanks
for sure.
for all these insights. So Pawan also messaged saying that he loved hearing all your answers, and I'm sure that we will
Thank you,
have
Pawan.
more of these classes in future. But thanks a lot for your time again, Vikram.
Sure,
Just one question that we have. Achai, Pawan is just promoting his startup so that next time he messages you, it's him, and then he open his chat box. So he's just saying that he's working on some lower airspace protection. Maybe if you get something of that sort, you might want to have a look. Yeah,
great.
cool. But thanks, Vikram. Thanks a lot. See you.
Thank you so much.
Sometime.
Take care. Cheers.
Bye bye.
Good luck, everyone. Cheers. Bye.